Let's get in Dhiraj Agarwal, the Managing Director at Ambit Investment Managers, who joins us on the show. Hi, Dhiraj. Good morning and good to see you win. How are you feeling about the market? Well, the stock markets, the economy was calling out for attention. Budget 2025 seems to have provided that. And now, hopefully, the RBI as well eases liquidity. How are you feeling about the market and anything that you're betting on as a sector for 2025?
So my view is that what the budget has done is fantastic, and hopefully RBI will also be pro-growth at this point of time. But I doubt if it will take away from the fact that we are looking at potentially a very tough year for equities. Largely because while these measures are necessary, they're not sufficient at this point of time to take the earnings growth for equities back to 13, 14, 15% range, which is where a smooth trajectory or upward trajectory restarts. So my base case view is that the 12% consensus earnings forecast for FY26, there will be disappointments on that despite all solid and brave attempts coming in from regulators and the government. And hence, this year is going to be a tough market, high degree of polarization. So basically, remember what happened in either 17 to 19 period or 2010 to 13 period, where a very narrow bunch of stocks tend to outperform or perform reasonably well, and bulk of the market will have to go through a little bit of a stress.
Dhiraj, the Gen Z that entered the market post-COVID doesn't know what you're talking about. Which are these periods? Does this even happen? So, well, if your forecast comes true, then it's going to be a learning lesson, I think, for a lot of the newer investors who got used to superlative returns after COVID, one-way returns. Take that point. Just allow us 1 minute. I'll quickly run through some of the important earnings reactions that have come through. The pre-open is there. And Hero Moto is a stock that's reacting the best. It's about 2% higher. Bharti is up 1% on very good numbers. ITC is absolutely flat. So these are large Nifty reactions that are playing out. Bharti is actually flipped. Okay, on my screen it was up about 1%. We'll just refresh that rate. Hero is up about 2% for the time being. Dhiraj, so if we are going to be in the kind of market that you described, it's going to be challenging. So where will you look to for whatever little wealth creation, even if it's, like you said, even it's single digits? I don't know if that's the kind of return you're expecting from the market, but what will the strategy be?
The strategy is to look for companies which can deliver earnings growth superior to Nifty. So let's say if the base case for Nifty earnings growth is about 10%. Then look for companies which can deliver predictable or safe earnings growth of at least 13, 14, 15% range, and not trading at obnoxious valuations. So that becomes a little tricky because there are a bunch of companies still capable of generating 20% plus, 25% plus kind of earnings growth this year. But the valuations have no room at this point of time for the stocks to appreciate. And my view is that you will see a huge amount of dispersion even within a sector. So not necessarily that one will be able to identify one or two sectoral themes which can do well in this kind of a market environment. But even within a sector, companies which are trading at reasonable valuations with mid-teens or early teens kind of earnings growth can deliver reasonable upside. And the companies struggling for earnings growth or whether the valuations are obnoxious or very high can actually see a downside this year. So this year will be a test of stock pickers' capabilities. This year will be a test for one's capabilities to accurately forecast the earnings. Because as we have seen in this earnings season and the previous one, every single miss is being harshly punished by the market.
Dhiraj, what about the sector that used to get very high multiples, and then in fact, in comparison to their 5-year averages, it's come down? I'm talking about the consumption, the FMCG pack. Now you have more money in the hands of a lot of Indians. So that's why that sector initially did see a bit of a bounce up. But it's still far from those growth rates that we have seen in the past. Will you advise rejigging the portfolio more towards consumption?
At least I won't. My view is that the tax cuts will probably limit incremental downside from here, but there is still downside. So, I'm just going back to the statement that companies need to deliver earnings growth superior to Nifty's to be able to perform in this kind of an environment. Now, let's take consumption as an example in the previous cycle. So between 2015 to 20, or more importantly, between 18 to 20, when we saw a similar market with high degree of polarization and a very tough market, Consumption sector was growing earnings between 13% to 20%. I'm not talking about outliers like Titan or Trent, but in general, 13% to 20%. But the Nifty earnings growth was more like 6 to 7. So they were growing at double the pace of Nifty, and predictably so. It was not that difficult to say Unilever or a Nestle or an Asian Paints will grow earnings at least in the teens next year. That theory is now being challenged, right? I mean, for the first time in certainly a decade, and for many companies for the first time perhaps ever, we're actually seeing earnings decline in many of the consumption names. I mean, Asian Paints has seen 2 or 3 consecutive quarters of earnings decline. And while the valuations have reverted back to 5-year mean, it sort of means nothing because we have never seen such a high degree of earnings unpredictability for consumption sectors. More important than the decline, one is no longer sure. Next year will be 5% or 10% or -5 again.
Dhiraj, I know, absolutely point taken. I'm sorry to interrupt. We're just running into market open, Dhiraj.
Sure.
And short a conversation today. Thank you very much for joining us with that perspective today. Well.